TheoTrade. This is Don Kaufman. December 30th, 2022. It's the final trading day of the year. Of course, everybody's talking about the past, what happened this last year. Look, everything you need to know right now is about the future. And the big question is, can you handle another year of extreme volatility? Because I'm going to tell you right off the bat, that is exactly what you should anticipate for 2023. And in this weekend's update, I'm going to explain to you exactly why volatility will not only be persistent, but in some cases could get even more extreme. Let's get right down to it. As I said, this is not going to be your year-end, weekend review kind of thing. It's over. It's done with. It's in the books. I'll show you a little bit about what worked, obviously, in 2022, but much more importantly, what's going to work, okay, in 23. So let's just jump right into it. Obviously, this week of trade, holiday week of trade, what did we see? Well, hey, listen, we almost tagged the lower edge of the expected move. We were hop, skip, and a jump away from it. We rallied back up. Today we threatened to sell off. We rallied back up. I mean, for the most part, if you look at the SPX, we finished the week, well, massively unchanged. Is that good enough for you there? When I say massively unchanged, I mean, hey, come on. We started the week at 38.44. We finished the week at 38.39. It's like a rounding error at that point. So what do? Move forward. Look, when I actually posed the question, can you handle another year of extreme volatility? As I said, I'm going to back that up with a whole lot, okay? And that's exactly what I'm going to get into right now. All right, why is volatility going to persist in 2023? And this may or may not be what you're kind of expecting, but I'm going to get right down to it. To begin with, I'm going to jump over to the spiders. Okay, so the spiders, the S&P 500, and we're going to go ahead and close up this left side bar for just a moment. And with that, I'm going to open up a max chart. All right, so what you're looking at, of course, right now is it's a whole lot of history inside of the spiders. And of course, I said this is not going to be a history lesson of what happened in 2022, and it's not. Okay, but what I want you to see is some of just these wild ups and downs. And you're going all the way back in here to like the mid 90s. I think I graduated high school somewhere back here and college here and started trading 3 weeks out of college. And then we hit this, and then all of a sudden the internet bubble, and then of course the financial crisis, and then right here. This is actually a fairly critical area, and I'm going to zoom in on it. All right, so there were some major market structural changes made right in this neighborhood here. So, okay, coming out of the financial crisis, what did we have? All right, we had legislation. We had Dodd Frank. We had the Volcker rule. Okay, but even more importantly, everybody's going to start to say, well, no, we had the Fed. And we did have the Fed. And what did the Fed do? They drove us, okay, to 0%. It's a whole lovely thing called 0%, but it gets better. Then they actually added a little bit of twist. Okay, why did they do the twist? Because in 2011, they thought we were going back into the financial crisis. And quite frankly, I was, running some of the risk and education and thinkorswim. I thought we were kind of going back into it as well at that particular point in time. Things got ugly in 2011. So, they have quantitative easing part 1, quantitative easing part 2, and quantitative easing part 3. Well, no, it wasn't called that. It was called the twist program, which just gave them unlimited capital out there. And then, of course, we went on an absolute buying binge. But I'll give you the argument that a huge amount of this, okay, has to do with a number of factors. But one of the primary factors was actually a change of complete market structure, which I'm going to explain here in a moment. It had to do with Dodd Frank and the Volcker rule, which we didn't have back into the financial crisis. We didn't have it during the internet bubble popping over here. And I'll argue again that this Dodd Frank, the Volcker rule, okay, coupled with 0% rates actually caused and fueled everything, okay? But it's not about, just the rally. It's about the progression of the rally, that it was basically just a one-way parabolic ticket to the upside. So let me explain now, all right, why we believe we're going to have considerable volatility to the future. All right, so as I said, Dodd Frank and the Volcker rule, let me actually come into real context of what those are about and why they can actually influence everything that you're doing. So on a week-to-week basis, we heavily track expected move. And the reason that we so heavily track expected move, right? Expected move is what the option market depicts risk to be, all right, in the forward future. For example, if you took a look at the SPX, the mother of all products, you went 7 days out, you looked over at the expected move next week, which is only a 4-day trading week, with all due respect, we're going, Happy New Year! But listen, all right, it's an $84 move being priced in. And you go, well, why is that so important? Because it's what the market making firms, proprietary trading firms, and basically any participant that's involved inside of the SPX, participants don't agree on anything. There's buyers and there's sellers, but those buyers and sellers average together equal about $84. Now, what's interesting, okay, about that is, again, we stay between the lines, right? So these lines are basically expected move. Expected move is known as like one standard deviation, right? So if you take a quick glance at this, you're supposed to stay inside of that 68% of the time. And we do, and once in a while, some fairly wicked breaches, okay? But you'll note that this expected move, it doesn't have any directional bias. Did you ever ask yourself why? Why doesn't it have any directional bias to it? Markets clearly have some directional bias. And it has to do with the fact that where these expected moves come from, all right, is a very pure place. It's basically dealer gamma. And what dealer gamma deals with is, well, okay, everything from gamma risk to the fact that dealers are market makers. Dealers are market makers. And if I explain to you, and again, I'm going to put this in a 1-week context, and then I'm actually going to put it to why we're going to have volatility in 2023. So this coming week, let me zoom in right here on it. All right, we're just going to zoom in so you guys can see it. This coming week, as I said, has about, all right, an $84 expected move. So that means plus or minus $84. So we're supposed to go up $84 or down $84, right? So this is also, again, it's deciphered by these trading firms that go out. They just trade tons of different options, both calls and puts, like this side's calls, this side's, that side call, and the other side is, of course, puts. And you average the prices together, it comes to $84. Would you ever think to yourself, if a market maker goes out, all right, and they're selling calls. So imagine that everything in here, the market maker has sold calls. So they've sold calls. So if you stay flat, the market maker makes a ton of money. If we start going higher, the market maker, they don't really get killed until we start trading outside this upper edge of the expected move. But right, the market maker doesn't wait for that. What they would actually do is the moment we start trading higher, the market maker has sold calls. Now, selling calls, when you sell calls, where do you want the market to go? You think about this. If you sell calls, you're like, no, don't go up, don't go up. I want the market to go down. The seller of calls wants markets to go down. But if the market doesn't go down, okay, what do they have to do? Think about this for a second, because selling calls produces what we term negative delta. Negative delta is offset by positive delta. They want to keep their equation to kind of zeroed out. And when I start talking about the equation, what equation am I talking about? Their delta equation, all right? The market making firms, which are also known as dealers, want to keep their delta relatively flat, all right? So as we start to go up, all right, they'll have to start turning around and buy. And they want to buy. Why do they want to buy? Because they want to neutralize their delta. Do they have to neutralize their delta? Yes, and that's the point I want to make. They have to neutralize delta. Why? Because the Volcker rule, all right? The Volcker rule is not heavily enforced, but everybody actually sticks to it, including trading firms, including like Citadel. They all stick basically to this rule, which is what we term bona fide hedging. What's bona fide hedging? Basically means they're going to be market neutral. Dodd Frank, the Volcker rule, okay, and bona fide hedging. All right, so if you have bona fide hedging, they're basically trying to keep that little ball kind of neutral. So even if we rally up here, they're still going to have relatively low delta risk. So how does that relate to a rally that persists, okay, for literally years? I'm going to tell you exactly how it persists, all right, for years. What you basically have is, if you have a retail trader and a retail trader comes in there and buys calls, are you retail? Yes, you are retail. All right. So retail comes in here and they buy calls. Why do they buy calls? Because we're going straight up. The more calls you buy, the more calls that the market maker, okay, this is the market maker, which is known as a dealer, they have to sell calls. The more calls that they sell to who? To you, the more stock they have to buy. And you start to perpetuate this wild up move. The crazy thing about it is the market makers, they don't give a crap. They're just making bid offer spread in here, right? They'll just continue to buy and buy and buy and buy. By the way, you know, when they buy stock, and they do it, they have to buy stock, they have to buy futures. When they buy stock, I'll tell you something interesting about stock. When they buy stock, the cost to carry over here was basically zero. What's the cost to carry now? Ooh, yeah, it's getting up there, like 4.25, 4.5. But they're not going to be able to borrow, right, at that rate. They're probably going to be paying a lot more. And it depends on the trading firm. Like if you look, all right, if you look at, you know, what we term like risk-free interest rates and so forth, according to thinkorswim right now, it's 4.25. I know it's 4.25. I don't think you're going to be able to borrow money as 4.25. Most of the trading firms are going to be 6 to 7%, maybe even higher. So their cost of carry has actually gone up. Ooh, now we're starting to actually get interesting. So the cost to carry is going to pressure dealers. What that basically, you know, alludes to is these dealers are not going to want to hold stock. So for the most part, their inventories, okay, their inventories, no one wants to hold a couple million shares of anything like Apple over a weekend. Now, Apple is, you know, degraded down to $129 stock, but it doesn't matter. Nobody wants to carry that kind of inventory, not because there's risk. They don't give a crap about the risk. They're neutralizing delta in real time. Okay, what they do care about, though, is if you own 5 million shares of stock over a weekend, add up some of the cost of carry. Cost of carry is a big influence. So the Fed influence, okay, listen, we're not in a zero interest rate environment anymore. Even in zero rate, some of these trading firms would still have to pay, you know, decent amount of interest on it. But right now, the interest rate has just, it's decimating the ability for these, okay, firms to want to carry, all right, stock. And as such, now you got a problem. Now you got a problem because they're going to be basically be playing hot potato. And the more they actually do that, the more volatility we're going to run through. And you have to realize that, I mean, when it comes down to it, how you make markets, okay, is going to influence every aspect of the market. I don't really care when somebody goes, but Kathy Wood bought like a couple million shares of Tesla. No one gives a crap. Okay, that's peanuts compared to the fact that, you know, firms are trading, you know, 8 and 10 million contracts and options. I mean, a firm like Citadel is going to be trading like half the liquidity in the entire marketplace is going through a firm like Citadel. What do you think they care? All they care about is cost to carry. Again, they're actually adhering to Volcker rule. They're doing bona fide hedging. They're not taking a lot of directional risk. There's some directional risk. You got to think about this. You got to think about this because as long as the Fed influence is there, what's the Fed influence right now? It's pressure. As long as the rates are above basically like 4%, how do you get out of volatility? You don't. Okay, you don't, and this is where, you know, eventually you'll come down to prices where the cost to carry won't be as much. Like the cost to carry is influential right now because you're still dealing with Microsoft. That's a $240 stock. If Microsoft's like $150 stock, maybe now the cost to carry is worth it. But okay, we are still at incredibly lofty levels, and right now all these market making firms, as I say, I kind of call it a wild game of like hot potato. They are not going to want to carry, all right, huge sums of stock for any period of time, all right? So what they're going to be doing is trying to unwind, all right, and that's going to create more and more volatility. It doesn't necessarily mean that it's going to be, you know, quote unquote bearish. And I want to be clear about that. So 2023, okay, you know, there's going to be a recession, there's going to be this. I think you push all that crap aside. I don't really care. I just don't at this point. I'm really, you know, I'm over the entire like recession conversation. Only conversation I would have over here is, right, this is where the Fed, right in this neighborhood over here is where the Fed went hog wild, okay? We're not back to that level yet. We're not back to the pre-COVID level. And there would be a precipitous drop, okay, to 325 just to be able to get back to that particular level. And, you know, at that level also, I mean, rates were sitting at zero over here. So again, we are going to have some rough trade ahead of us, you know, and that's pretty much without unequivocation. So again, you know, you guys, you know, feel free to look yourself at Dodd Frank, Volcker rule, what bona fide hedging is. It's funny because if you look up bona fide hedging, nobody knows exactly what the bona fide portion means. It basically means stay within the guidelines. What are the guidelines? Try to be market neutral as possible, okay? And don't, you know, arouse any suspicion from obviously when they do the stress test and the Fed actually steps into any of the banks. Okay. Again, cost to carry though is going to be big pressure on the dealers, going to be big pressure on the banks. Nobody's going to want to actually hold inventory. As long as they don't want to hold inventory, we're in a hot potato, high volatility marketplace. That's it. All right, what's going to work in the new year because of this? You're going to sell premium. All right, you're going to sell premium, and I'm going to tell you right now, you're not unequivocally not going to sell premium in the short duration, because the number of breaches that we're seeing of expected move is still wild. Like, markets are coming apart at the seams. That's 2 sigma move, another 2 sigma move. Like, it's kind of Mr. Toad's wild ride out there, both to the upside and the downside. So you're going to sell premium. You're going to sell back month premium. When I say back month premium, I'll open up the S&P options and futures here. Okay, so I'm selling options. I may have 91 days left, or 112 days left, and I only have to hold these options, okay, effectively for 30 some odd days. My average hold is about 30 some odd days on these options to be able to make over 50%. Don't tell me that these options don't have great decay, because they do. That's what Ultima is all about. They have phenomenal amounts of decay, but at the exact same time, okay, I don't want anybody to, he's selling options naked and just, it's a ticking time bomb. Absolutely not. I'm reducing risk with actively hedging. I actively hedge stuff, risk to a spreads, inflection point spreads. Look, what's going to work in 2023? Catapult. Catapult is in right now. Inflection point spreads is totally in right now. And that's what we've been doing. I mean, you can see the number of catapults I even have on right now in this particular account. And again, one of the things that we're so adamant about here at TheoTrade, this place is no holds barred. If I'm doing something, I'm going to show it to you, right? So what's going to work in the new year is it's a version, it's a theme of exactly what worked in 2022, right? Are we going to see some extreme volatility? Yeah, bring it, bring the pain. All right, the more pain you have, the better it is going to be selling premium. It doesn't necessarily mean that VIX is going to stay up above 20, but it doesn't hurt, right? If the VIX does collapse back down, Catapult's still going to play nicely. Inflection point spreads, okay, will still play nicely with others in a lower VIX, okay? But my cautionary tale's on the other side of this. I don't think we've actually seen the VIX erupt. And when it does, you're going to feel it, and you better understand that. That's why I'm actively hedging when I'm selling premium. So that's clearly going to work in the new year. All right, the next thing we do each and every week, we talk about get your trade on, this week's profits and losses. I didn't take a whole lot off this week. It's a pretty mellow week for me because we slopped around a little bit. What I do want to explain to you, though, is a little bit about year-to-date profit and loss. Everybody asks me. So as I said, no hold barred. Here's profit and losses on the year. Okay, take a quick glance towards the bottom of the screen. By the way, on thinkorswim, it's pretty easy to see profit and losses. Like, you could just highlight, certain positions and say, hey, this is the right position over here. Look, it's $191,000, $191,028.65. Okay, now everything hasn't necessarily settled. Of course, you're going to ask what the account value was. The account value, this is a 5-day net lick. 5-day net lick. The account value at the end of the year is $356,000. So you do the math, it's up just shy of $200,000. It's not bad. Now, of course, everybody's like, well, but, look, okay, there's no if, and, or but about it. The profit and loss is based, okay, you can't add money to the account because the profit and loss is based exclusively on me highlighting every one of the products. This is every single product that I traded. If I highlight every one of them, it's what? $191,000, period. Okay, you can even see certain products in here. You can like highlight and say, how did I do just in the S&P options on futures? Up $24,000. Okay, how did I do, for instance, on the Nasdaq micros? Okay, up $44,000 and so forth and so on. You can actually go through and break it down, but it's about $191,000 of profitability in some other accounts over here. Okay, and I've got a bunch of accounts. Here's actually an IRA. By the way, this is a very small IRA. My larger IRA, and I have multiple accounts. My larger IRA is over here in Tastyworks. Tasty! Okay, that's over here. However, the smaller of the IRAs is actually up approximately $42,000. And I say smaller IRA. The 5-day net lick is about $76,000, but I was up almost $43,000 on the year in that particular account. So again, you figure out the percentage returns over here, go for it. It's something I don't want people to look at this and say, yeah, he's making over 100% in a volatile year. Okay, you look at it. All right, listen. You've got to tailor the risk to you, but don't ever say that, oh, you can't do this and you can't do that, because we've been incredibly consistent. And again, we're going to continue this no holds barred approach where I don't mind showing profit and losses. I don't mind showing year-to-date profit and losses. I don't want to imply anything. Okay, but I do want you to understand, don't tell me that people don't make money in this marketplace, because this is it, people. This is where you actually kill it. We're even doing auto trade right now. And the auto trade program only kicked off, okay, I only kicked off the auto trade program, okay, well into 2022. And we still did over 10%. And we never had more than a few $1,000s of capital at risk at any point in time. All right, last, okay, but finally, all right, as I said, Catapult is playing really, really nicely. I added some Catapult specifically to Caterpillar versus S&P. I also added a bullish trade to Tesla. This is actually a trade where I got very, very bullish in Tesla and financed the entire Tesla position by selling S&P options on futures. So Catapult is actually something we just finished a 4-day class specifically on that. It is now available today, now over in the coaching archives. It's called the Catapult Sessions. There are actually 4 sessions. The Q&A, of course, is coming up next week for that. I actually call it the Catapult Confessions. You guys will love what we're doing in terms of Catapult. As I was saying, last but definitely not least, I come to the SPX, the expected move. This next week of trade. It's simple. It's very, very straightforward, okay, in respect to the fact that what we are looking at in terms of risk is about an $84 move in a 4-day trading week. Yeah, we're going to have another 4-day trading week, okay? I'm not going to say anything other than this, okay? Get ready, because we're going to come out swinging in the new year. So markets are closed on Monday. Obviously, the new year falls on a Saturday into a Sunday. January 1st is Sunday, so they're giving us off January 2nd. 2 days to recover, people. 2 days. It's going to be a wild new year. And then, of course, you're back on Tuesday. And one of the reasons I say it's going to be wild, we're still so data dependent. Like, look what's coming. All right, look what's coming. PMI manufacturer. Oh, don't worry. All right. I mean, there's a lot of numbers that are going to be out this week. But of course, you end the week with a little PMI construction. Nah, that's nothing. You got to worry a little bit about factory orders. But the big one, the employment situation. Dun, dun, dun. Oh, I didn't even mention the fact that Fed minutes are going to be out. Oh, yeah, that's going to be a party too. They're going to come back Tuesday. By Wednesday, Thursday, this marketplace is going to be swinging. Don't be surprised to see some vicious moves to the upside. But again, the theme is a very simple one. There's been some pretty severe sell side activity, and I think that's actually going to be some persistent trade with volatility. A little side order of volatility in the first week of the year. With that, again, you got to be able to handle. All right, another year of extreme volatility. We're far from done. When the Fed finally steps back, okay, stops diminishing the balance sheet, stops actually with the rate increases and starts to back things down, they may feel otherwise. Listen, it's not all the Fed. Okay, there's a lot going on right now that's going to be infiltrating this marketplace and causing volatility. You just got to be prepared for it. Thanks everybody for joining us here at TheoTrade. Want to wish everybody a very happy, very healthy new year. Thanks, everybody. Bye-bye.